Hey there, YouTube family. This is Josh with Stocks with Josh. And today we're going to take a look at dollar cost averaging. Are you dollar cost averaging correctly? Can we continue to dollar cost average into this bearish market? Does it make sense to continue to put money in when the market is falling hard from week to week? What are our options? We're going to take a step back and we're going to look at the fundamentals of what dollar cost averaging is. Before we begin, please hit that like, subscribe, and that notification bell. If you're not getting the notifications and you've hit the notification bell, go into the settings on your phone and allow notifications for YouTube. So, what are our choices? We've just come out of a bull market last year. And in that environment, a lot of people began to invest for the first time. There was just a ton of hype around it. SPACs were firing off left and right. People who had no experience were just taking a lump sum of money and throwing it at what SPAC was the hottest that week. And the only thing that they might have done wrong is they didn't put more money in. Things were just moving up, and by the time you cashed out of that position, there was another hot SPAC or hot EV project right around the corner. Okay, and so a lot of money was made. But we've now, transitioned into a bearish market, and that easier investment time has come to an end. And so, what's going to happen is a lot of people are going to just not succeed. Their whole portfolio is going to get red. They're going to get margin calls. They're going to begin to, pull money out and just fold at this point. But it is so much. There's so much more money to be made ahead of you. In a bear market, fortunes are made. The volatility in the market provides for so many opportunities, but it's time to get to the fundamentals. It's time to invest into the knowledge so that you can continue, and as I say it, to make money in that magic money printing machine that is Wall Street. So we're going to take a look at dollar cost averaging, and we're going to look at, are we doing that correctly? So what are our options? Like we talked about just putting in lump sums. Is that not going to work anymore? No, there are plenty of people that are just throwing lump sums into the market right now, but let's talk about how they're doing it. Those are day traders, right? And there's a lot of folks who are working, a 9-to-5 job, and they can't sit there and throw a pile of money in the market and watch it all day long. And that's the only way that you could actually continue to put money in, is if you had a very strong technical plan for that money. You were sitting there watching it, ready to close a position or increase a position in the moment based on a very strong technical understanding. And if you're not able to do that, then the only strategy that makes sense or that is left for you is dollar cost averaging. But a lot of people are doing dollar cost averaging incorrectly. So let's take a look at it. They're trying to transition from a lump sum investment into a dollar cost averaging investment, but that's just not the way it works. So dollar cost averaging, I'm going to break it down to you for what some of the fundamentals are. So fundamentally, you take first a look at the total amount of money that you want to invest. You have to understand your risk range. You have to understand if you're going to move into a position over time, you have to understand how far that position could drop. So you're going to look at your investment in 3 ways, okay? You're going to have your base order. That's your initial order or your starting position. And that is, believe it or not, going to be your smallest point of entry. Every other point of entry after that is going to be larger. That's correct dollar cost averaging. So if you start off with, if all you have to invest is 5 grand and you start off and you put all 5 grand of it in at the beginning of the trade, you just don't have the liquidity that you need to get out of it. You don't have the safety. So the initial investment is called your base order, and the orders that you put in after that are called safety orders, because that's literally what they do. They keep you safe. And you look at your risk range. I talked to you guys about this on most of the shows that I do. I give you guys risk ranges. Your risk range is going to be a lot of times your support level. And sometimes, right now, we're at historic support levels for all the stocks. And then above that, it's the next level that maybe had previously been support, but now we're calling that resistance. And so if we're trading in the middle of that range, let's say that the support level below is $5 and the stock is currently trading at $10 and the support level above is $15, you actually don't have a very good profit to risk range in that trade. But let's say that you're at the historic support is $5 and the stock could go to $15 and you're sitting at $8, okay? So you're just above a support, right? So you're going to take your you're going to figure out the percentage between where the price is and where the support is. And that's the potential that the stock could drop. All right. You're going to then look at that percentage. Let's say that percentage, it's 20% above a support level. Okay. So you are going to take the total orders that you have, and let's say that your total amount of investment is 10 grand. All right. And your initial order for the stock is going to be 1,000. Right. You have the ability to divide up the rest of that investment into potentially 9 other trades, right? But dollar cost averaging has some additional fundamental ideas behind it, right? As each trade goes in, you actually want to increase the percentage down that you take to put the next trade in, and you want to increase the amount of money that you're investing on each consecutive trade so that the last trade or investment that you make is actually at the lowest percentage and the highest price. So an example of that would be is if you had $10,000 to invest and your first investment, your base order was $1,000, your next investment might be $1,500 and the investment after that might be $2,000. Now the second trade, you might say, I'm going to make when the stock comes down 5%. But the third trade, or it would be the second safety order, you're not going to take unless the stock comes down, maybe 7%. 3 to 5% is normally the ranges I work with. But I'm wanting you guys to understand that you cannot turn a lump sum investment trade around with dollar cost averaging investments. Okay, now you could, but you would need a lot of money to do that. You would need the liquidity to support that, because remember, all of the additional trades have to be bigger than your first trade, right? That is what you need to understand about dollar cost averaging. Now, there is a concept of long-term dollar cost averaging investing, right? Like with Larry's $1 million cup of coffee. And I'm going to do a video explaining what to expect, because with every trade, you have to have an idea of when that trade is going to turn positive. So, you've got to have the goal very specifically dialed in and in mind. And so I'm going to do a follow-up video on that. I'm trying to reveal to you guys how to set up your trades. We've done some videos on actual charting to show you trade setups from a charting perspective. But what I'm talking to you guys about right now, dollar cost averaging, is trade setups from a liquidity perspective. Right now, this is a journey that I'm taking with you all, and I'm using the small account challenge that I'm talking about ideally every Monday. I'm using it as a way to introduce these principles to you. The small account challenge, if you want to participate, you go into the description of this video, you click on the link for Moomoo, you download it, you fund it with $100. I specifically chose that platform because of the types of order types that you're able to do on that. It's commission free. You're able to do the stop losses, the market if touched orders, as well as the fact that I'm going to eventually use it to introduce you guys to shorting the market, which I believe is going to be, I think we're actually going to have I mentioned this earlier in the week, that we could potentially be looking at a flash down. That's actually what I'm expecting. I think that flash down is still ahead of us. But I believe that after that, we're going to have a melt back up. And we're going to see potentially back at top levels in this market. That's my anticipation for this market at this moment. So there's going to come a moment in time when we're getting geared up and set up to begin to short the market, right? I don't actually think, I mean, there is money to be made from shorting, but that isn't where, I don't believe that a lot of you are ready for that yet, and I'm going to build us towards that through this, not this small account challenge, but when we complete the one we're in, that's going to be on the horizon. So I have hope that I've given you a little bit of a conceptual understanding about what dollar cost averaging is. We're going to come back to this and we're going to talk about it as we're going through different trades. I hope that you have a little bit of a fresh idea or a fresh perspective of what you're doing on that. And I appreciate you letting me be part of your financial journey. Hit that like, subscribe, and notification bell on my way out. And anything I said is not a suggestion to buy, sell, or hold a stock. Thank you.